a listen to this. Tom Lee says small caps are the biggest trade of 2024. And if you want my honest opinion, likely the biggest trade of 2025 as well. I know what you're thinking. Of course, we're going through a correction that looks to be the most obvious path forward. But after this correction, I think it's critical you start focusing on where you want to buy, what you want to buy, and how you want to position in our markets for what's going to benefit over the next 6 to 12 months, because this is a bull market until the economy weakens too much and Wall Street starts throwing around the R word, which is recession. And from every metric you can look at, from EPS growth, from multiples and valuations, interest rates coming down, small caps are the clear winner for at least the next year, if not maybe multiple years. EPS growth is actually going to outpace the S&P 500 over the next 3 years, with the median stock in the Russell 2000 trading at 10 times 2025 earnings. It's much cheaper to buy these small caps than even the S&P.
And as you know, we've posted this chart that small caps, financials, industrials, they've been basically putting on a recession trade because they've been worried the Fed's overly tight, waiting for the Fed to cut. Well, these are all reversing pretty massively right now. And as you can see, small caps relative to large cap follows what the Fed's doing very closely. This is another chart. If you've been following our research, we've been showing you some time. On the following topics: small caps, believe breakout or not. The second is regional banks and biotech. But lastly, and I think it's an important point he and I've talked about, is the small cap rally coming at the expense of a large cap rotation? If he believes that, I need to make that clear to you guys, that in the short term may not be good for large cap. I think stocks performance is not as affected by presidential election outcomes as many think. Sectors, certainly, because administrations pick winners and losers in terms of policy. And I guess the thing to think about is if there's a Republican sweep, that they take the Senate and the House. I don't think Tom Block has weighed in on that view yet, but that to me would be the only thing that could change the dynamics about what could happen in markets.
So, I mean, how do you argue with Tom Lee's points there? I mean, yes, he did say in the near term, a rotation, an outperformance of the Russell, which we have been seeing even on these red days, could be a negative for the S&P. Now, we all know a correction is over needed at this point. What happened after last earnings is you got a correction. Now this earnings, you're likely going to get a correction, and you didn't even get a technical correction. You only got 6% down in the S&P during last earnings season. The average drawdown in any year is 12% for the S&P. The average drawdown during an election year is 13%. So, I mean, if we get a 13% drawdown, that's going to put you almost exactly to this 200-day moving average at about 491. And, there can be a lot of things that happen that are unforeseen. A couple of weeks ago, we would have never thought Biden would step out of the race. Now it looks like he might. There's a chance that he will. And if that does happen, I think that could cause, at least, well, I know that would cause a lot more uncertainty, which would cause more downside for stocks, right? Uncertainty equals downside. Bad news is easy to get over, but uncertainty is not, especially political uncertainty during election years. That doesn't tend to be well for markets. But really, you can't argue with what Tom Lee is saying here. More cuts is positive for small caps, especially if we do get a Republican in the White House. That's likely to be more pressure on Powell to cut rates more, especially if we keep getting these super soft inflation reports. And we're actually hearing more about deflation than inflation these days from companies that are actually needing to lower prices to attract people back into their stores to buy their products or use their services. So if this recent trend continues, it's logical we get a lot more rate cuts than we're expecting. And as long as we don't go into a recession, small caps will be the outperformer. Now, I know I keep saying this, but you want to pay very close attention to what's going on in the economy. Because if the economy weakens further and Wall Street starts throwing around that R word, that recession word, you're going to be looking at 30, 40, 50% downside from current levels. I think you get no more than 15%, a 15% correction without those recession fears coming about. But we are starting to see a spike in initial jobless claims, in continuing jobless claims. We're starting to see some retail sales data come in really bad. You're starting to see consumer spending data coming in kind of on the rocky side. If these trends continue, then in a couple of months, things could be worse off than they are today. But that is not a base case assumption. And, going into a recession during an election is not good for the guy that's currently in the White House. So, perhaps we continue to see data that is perhaps better than the actual situation is. I'm just going to put it that way. I don't want to get too tinfoil hat here, but the last thing you want if you're the current administration is a recession, because then your chances of winning the election go basically to zero. There's only been one president that has ever won a re-election if there has been a recession within 2 years of that re-election, and that was William Taft back in 1913. So it almost never happens that you get reelected if you have a recession within 2 years before the election. Now, I do want to share this clip from CNBC with you and one other. This one's 4 minutes long. It says inflation, interest rates, and earnings could be headwinds for stocks, says Wells Fargo's Scott Wren. And I think it's important to take the institutional perspective of markets as well, because when institutions start to flip, a lot of dollars start to flip with them. And this can give retail a pretty good insight to what could be coming next.
Let's talk about where you would, I guess, reallocate any portfolio funds you might have right here, because even though it looks like just an orderly 3% pullback in the S&P, there's so much movement below the surface. I wonder if it's surfaced any opportunities for you.
Well, I think, Mike, it's a little early for that. I mean, in our opinion, this rotation that we've seen into small caps, that's not something that's going to last. We think we're still in late cycle, not early cycle, where, small caps and high yield bonds and that tend to perform early in a cycle. So we don't think we're there yet. We have been hoping for a pullback because we do have a little bit of cash. We think tech and communication services are a little overvalued here. And I don't think it's really a bold call. If you're looking for a 10% pullback, after the kind of run that we've had since the October lows, I think that's very doable. And so, 3%, that doesn't get us interested yet. But I think we have some potential over the next couple of months for a little more downside.
I mean, what do you think would spark that? Not that you always need some specific cause, but it seems as if the market is, getting pretty comfortable with the idea of, soft economic landing, Fed's going to cut rates. Maybe we get some friendly policy measures out there, but who knows? I guess, is there something in particular you're expecting to disturb the market soon?
Well, I think at this point of the cycle, it comes down to what inflation's going to do and what the Federal Reserve is going to do about it. And I think right now, whether you look at what the market expects in 2025 or what the Fed expects in 2025, I mean, they're expecting a lot of rate cuts between now and the end of 2025. I think, we've got 2 penciled in this year. I would still argue that if we're wrong about that, it would be fewer rate cuts, not more. And of course, we're running out of meetings. But I think the thing that would spark some sort of sell-off is inflation is stickier. That's one thing, which would cause the Fed to leave rates or where they are, not cut much at all. And then I think also this earnings season, has the possibility of not coming in with nearly as high a beat rate as we've seen in the last, 3, 4, 5 quarters, which, that's been, 400 basis points better than consensus pretty consistently. So, if we come in line or just less of a beat, I think the market's going to get a little bit concerned about the magnitude of the slowdown and really what that's going to do to earnings. Because as we look down the road 12 months or so, it looks to us like the consensus is a little optimistic on earnings. So I think, those are two things, inflation, interest rates, and then earnings that could take us down a little bit.
You continue to kind of lean toward a quality bias, but you also said that tech and communication services look expensive. That's often, where a lot of the quality names are. Where would you focus if you still want to take advantage, really, of this rotation out of quality into lower quality recently?
Yeah, and on this run up, and you're right, Mike. I mean, tech and communication services have plenty of quality, but tech's about 32% of the total cap of the S&P 500 now. So if you're neutral there, I mean, you're carrying a pretty good load. But we have interest in industrials. We have interest in healthcare, which has been a little difficult. We have the most interest in energy. We think there's still a shortage there, and even if the economy slows further, like we think, we want to get into that. So materials, we still like materials. So I think those are some of the things that we think are undervalued relative to what the outlook is over the course of the next 18 months or so.
I want to share this clip with you that says, proceed with caution in the short-term trade, says RBC's Lori Calvisa.
Well, the major averages are approaching the end of a difficult week. Joining me now at Post 9 is RBC Capital Markets' Lori Calvisa. So, Lori, what started maybe a week and a half ago as the vaunted broadening out and the healthy rotation and whatever other cliche has gotten a little bit more jumpy. What's the message you're pulling out from this action?
So I think there's so many things going on at once, and I think that's what's really hard about dissecting this week. I think on the one hand, we were looking at stretched sentiment levels, right? On a number of different indicators, markets were starting to feel full in terms of valuations, this big cap growth part of the market in particular. And so we've had a lot of nervousness under the surface about that. On the other hand, you've had this broadening out, and I looked at some of the Russell moves earlier this week. They were just so sharp and so severe. I mean, it feels like we almost did, in a couple of days what it took us 2 months to do last time before. And I think just whenever things, move that quickly, even in Russell land, right, where we're used to these big moves, it unsettles people. And it's not surprising to me as we're ending the week to see that retrench just a little bit.
You hear a lot of folks looking at the unusual degree of these moves. And you can kind of back test and say, what does it usually tell us and where does it go from here? So when you have the general backdrop of it's a bull market, we're up double digits in the first half, usually that continues higher at some point through the rest of the year, right? That's your overarching piece. And then, when you have this much positive breath or this kind of momentum surge, or when the Russell has this kind of a tremendous move relative to the rest of the market, it tends to be important. In other words, it's not just a blip. So do you take those on face value, or is there something about this current setup that's different?
I think you have to go and just really look at the whole picture. Last week there were all these people running around saying, well, and I forget all the exact stats, but the Russell's up X amount, the S&P is down. That's not happened since X date. Exactly. What does that mean? Yeah. And I actually just went back and back tested it, and over the next 6 months, Russell only outperforms S&P 35% of the time. Now, I'm not telling you it's not going to do that here. We've been neutral on the space and looking for an inflection. But the reality is you've had plenty of those big jumpy moves and these weird divergences in down cycles in small cap and up cycles or outperformance cycles in small cap. So you really have to step back. And I think what's so hard about this moment is the positioning has been really, really in favor of a small cap reversion. The valuation maybe a little less so. Cheap, not as cheap as we were even last Halloween, but certainly supportive.
You're talking about small caps.
Small caps, yeah. And if you look at like the Russell PE was around 14.5 times, a week and a half ago, right? That's a little below average of 15.2. So you had that valuation room, and then we got this big enthusiastic, vote of cuts, from the CPI data. Yeah. And so you had people just moving in a hurry. one question I have is, have we overdone the Fed optimism once again? My rate strategist was telling me he's getting questions about, 50 basis points, and we've seen one big house, I'm not going to say who, make a July call, and that's not really the preponderance, of the calls out there, but we have done that so many times. So I think you want to proceed with caution here. There are a lot of good reasons not to be bearish here. But if you're trying to make that short-term trade, it's hard for me to sit here and tell you we're definitely out of the woods.
Yeah, I mean, you mentioned at the start there's so many things going on. So among those things, you mentioned, huge surge in confidence about a soft landing. The Fed's going to nail this. We're going to get a cut in the next couple of months. And then you layer on top of it the perceived certainty about the election, and not only that, but then what it's going to mean for different parts of the market.
And I think that's been a fascinating conversation this week. I've been a little bit quieter on this issue because to me, this has felt a little bit like the regional banking crisis a year ago. And what I mean by that, not that I think that it's any big nasty thing, but I do think that sometimes you just got to let events unfold and not try to guess every twist and turn.
You had people rushing from that Silicon Valley Bank thing saying, Fed's going to cut now,
right?
And it's going to be another crisis, whatever.
Right. It turned out to be a very well managed crisis, and there were a lot of things that kicked in. And if you look at where we are, I think at the beginning of the week there was a lot of questions on small cap. Is this about the Fed? Is this about the election? I'm actually pretty sure that one was mostly about the Fed and CPI based on my conversations. But I think it was a legitimate thing to ask about. At the same time, you saw financials and energy really making some big moves. It was all based on historical playbook analysis of 2016. As we got deeper into the week, some conversations with people saying, is it really going to repeat this time?
Right.
And I think there is some skepticism out there.
Yeah, and it's certainly a kind of a different setup, just the economy, where it's at and everything. How does earnings filter into all this? You started to see, I guess, which we've become familiar with, a little bit of a sell the news reflex. But in terms of what earnings have to prove?
So I think earnings have to provide you the basis for further rotation. And what I mean by that is if you look back to last November and December, we had cheap valuations in small cap. We had, under-owned positioning, and we popped. And we also started to see earnings momentum improve relative to small. And what I mean by that, you had pretty similar rates of upward revision in both the S&P and Russell. Contrast that with most of 23. It was all about the big caps pulling their earnings estimates up, and things were lousy and small. What we're starting to see right now, I'm actually, pretty excited about. You are seeing that small cap earnings revisions are catching up to large cap. Unfortunately, this is kind of happening at a time when, there's kind of some softness generally on that stat. But we are sort of seeing that earnings case starting to be made. But we really have to make sure it's going to come through, because if you go back to January, we basically saw valuations stopped looking cheap, the positioning stopped looking under-owned, and the earnings didn't come through. And oh, by the way, people were too optimistic on the Fed. I don't have an answer on that Fed question right now, but we're going to get an answer on that earnings question in the next couple weeks.
Yeah, so it ended up being kind of a fleeting, window of time of outperformance.
So, yeah, I think it's important when you start to get big fund managers, that was RBC's chief equity strategist there, that start to sound cautious. It does tend to usually lead to more hedging, which can lead to more downside pressure, leads to more profit taking, and can lead to a larger self-fulfilling correction. And with valuations where they are on the S&P, you are still almost priced for perfection. I mean, things need to go perfect for valuations to make sense here. And that's another reason why I really like small caps right now, is because you are not priced for perfection in small caps. They do also make a good point that maybe we are getting ahead of ourselves as far as Fed policy. The Fed has only forecasted one cut this year, and now the markets are pricing in 3. I wouldn't be surprised if we start to see more hawkish comments from Powell, even potentially by the end of this month, which could come as another kind of slap in the face to markets. But I do think right now, before and during corrections, is when you want to obviously pay attention to, the downside and just if things could get worse. Again, I think the kryptonite to this market is the economy. If the economy gets worse, recession starts to get thrown out more, you're going to see more selling, more cash being raised, more hedging. All of that is bad for markets from a downside perspective. But you also want to take this opportunity to really get your shopping list finalized, to really look at companies that you want to buy that have been a little expensive for your liking. Because if the economy does hold up, this will only be a correction, and 2025, odds are will be a great year for markets. But again, that comes down to the economy more than anything else. And I think it's still a little early to tell how much the economy is really going to weaken. And the historical precedent is you usually get some weakness before elections, and then after the election, the last 2 months of the year or so, you tend to see a pretty violent buy the dip rally. So let me know what you think about this down below in the comment section. Let me know what stocks that you are looking at to buy for your portfolio down below in the comment section. That is going to go ahead and conclude this video. Like I said, hit the like button and subscribe to the channel if you made it to the end of this video. Most importantly, enjoy your weekends, and I will see you in the next one.